Good morning, everyone. Good afternoon, depend where you are. I am in Aussie franc, and we are about 700 profit, and Aussie dollar about 878. So right now, I'm holding this trade for a while, and I'm just trying to wrap the months. So far, we are up for this year 324,000 for last couple of years. We started this account with 10,000. Now for 2 years we did about 324,000. For gold account we did a few trade today. We took short and we cover, we took long and we sold here, and we took long again, we sold here, we took short and we covered the position here, and we took long and we sold everything here. So we did a lot of trade today. This account
Lower this morning after
is
three
about
straight days of gains for the markets. We'll get you up to speed on what's moving.
this account we did so far this month 5,449, and for last 3 months we did about 39,897, and for the whole year we did about 154,000. So let's watch our trade now, and I'll keep you updated if we have anything else.
And along with Becky Quick and Joe Kernan, let's show you the futures as it stands right now, about 2.5 hours before the market opened. We're in the red this morning. Dow looks like it would open down about 103 points. NASDAQ, though, off about 71 points. And the SP 500 off right now about 16 points, Joe.
Thanks, Andrew. Let's get to Dom Chu, who, what was your alarm setting this morning, Dom? For what's in seriously, what was it set?
The worldwide exchange shift. When I do work that show in place of Brian Sullivan, my first alarm goes off at 2:15 a.m. and then I hit snooze.
Hey, by the way,
once, yes.
Dom did fast money last night, too.
I did. Becky, you were paying attention.
I was. When I saw you this morning on Worldwide Exchange, I was like, wow, that's a quick turn. Where'd you sleep?
Whenever the boss lady, whenever Lacey O'Toole says, go do something, she says, take that hill, as we all do. Yes. Exactly right. So I listen to Lacey and she tells me what to do. And she said, work fast money and then turn around and work Worldwide Exchange. So I'm here, but I'm spry. I've got a couple of cups of coffee in me right now. Yeah. But to your point, Joe, the early wake up call did lend me to kind of get a little bit more of a beat on what's going on early morning. So I do have 3 movers for you this morning that are worthy of note, only because they have very interesting storylines behind them. The first of all, you got Hormel. It's an earnings-driven story. Those Hormel shows are up about 2% right now. It's been an underperformer on the consumer staple side of things, but the company behind Spam and, Hormel chili and Dinty Moore beef stew and all those things came out with better than expected results, profits, and revenues. It was helped along by better sales in its food service channels, 33% better than they were pre-pandemic. So that's helping to drive some of that Hormel positivity there. Again, a catch-up trade maybe, but it's still up 2% right now. Keep an eye on Hormel Foods and, of course, the entire consumer staples sector because of that particular move. Also, watch what's happening with shares of Apple. We often talk about it, but again, Katie Huberty earlier this week over at Morgan Stanley took her price target and overweight rating on Apple to a street high $200 per share. We saw that on Tuesday. Well, today she's out with a note basically saying that Apple is now her biggest large cap favorite call in 2022. So kind of adding on to some of those particular positivity, I guess, comments from Tuesday. She's basically saying this time around that the recurring revenue stream for companies like Apple make them very attractive. And so she calls it her top IT hardware large cap pick for next year. So watch Apple shares. And by the way, if it does get past that level, it does become a $3 trillion company. So just kind of keep that in mind, hypothetically speaking. And then one other one to watch is a smaller cap stock. It's EVgo, electric charging stations. This company gets an initiation by analysts over at JP Morgan with an overweight rating and a $20 price target. That, again, is driven in large part by this notion that there will be wider fleet adoption, wider utilization of some of those electric charging stations that they have in their charging network overall. So we've got Hormel, guys, we've got Apple, and we've got EVgo, the entire spectrum of market caps covered in this particular one, Joe.
I'll say, yeah, that's below a billion. Don, what is that, 800 million or so?
Roughly $900 million at this point right now, yeah.
All right, thank you, Dom Chu.
You got it, guys.
It is the gift that keeps on giving. The holiday edition of the CNBC All-America Economic Survey is out, and it is loaded with goodies about how much Americans plan to spend this Christmas season and where they plan to do that spending. Our senior economics reporter, Steve Leisman, joins us right now with the details. And Steve, do tell.
Yeah, Americans plan, Becky, to spend with gusto this holiday season, despite concerns about the economy, inflation, and worries whether they're going to get their gifts on time. The CNBC All-America Economic Survey finds that individuals on average plan to spend $1,004 on gifts. That's up 13% from the pandemic-depressed level last year and the highest number since 2018. It does, though, eclipse the 2019 level before the pandemic. Among the 800 Americans that we surveyed throughout the nation, 15% saying they plan to spend more this year. That's up from 11% in 2020. 35% plan to spend less. That's down from 39%. Now, among those who plan to spend more, here are the top reasons. They have more cash in their pockets. They have more people to buy for, but also because prices are higher. Higher prices and trouble paying bills. You can see that on the other side, a top reason for those saying they're going to spend less as well, along with views that the economy overall is in poor shape. Lower earnings and a desire to save also making the list. So the survey was conducted after news of the Omicron variant became pretty well public, and it still found Americans far less concerned than they were a year ago to go out in public, shop at malls and local stores, visit big cities, or fly on planes. That could explain why the percentage of Americans who say online is their top shopping destination fell to 50% from 55% a year ago. But you see there in the chart, it's still above the level before the pandemic. That may be some initial evidence that some of the move to online shopping during the pandemic could endure once this thing is over. Worries about supply bottlenecks, they crept into the survey. A quarter of the folks said they were concerned their gifts might not arrive on time. And 36% said, well, they shopped early to ensure Santa's presents arrived in a nick of time. Becky, this is the 15th annual holiday survey of the All-America Economic Survey.
I think you're right about some of the online gains from the pandemic sticking around as people realize it's just easier. And once you're set up and your information's logged in, it's 3 clicks and it shows up in a lot of different places that you can shop. Steve, I heard something this morning on Worldwide Exchange, and I've kind of been kicking it around. I'm glad you're here to talk about it. It's related, but only tangentially. They were talking about how the savings rate for Americans in October, according to the Federal Reserve, was 7.3%. I thought, that's actually pretty good. That's a relatively high number. But then they said, of course, that's down from the high during the height of the pandemic when it was a crazy 33%. I was just trying to figure out what's the optimal rate. What does the Fed consider to be the optimal rate? Because you want people to save and have some savings, but if they're saving too much, it means they're not spending and the economy goes to hell. So what's a good rate?
Nobody knows, Becky. I mean, we've had numbers. I can't remember. They readjusted the whole series, as I recall. It used to be down in the 4s and the 5s, and then I think 7 is an average or 6 is an average. It was way higher. It came down. Look, this is one of those things that it cuts both ways. Savings can come down because consumers are under stress and they're using their savings. They can also come down because people are optimistic about their earnings. So it's a little hard to tell what the optimal rate is. I always say that one shouldn't be so bold as to tell people what their optimal savings rate is. People come up with a number, and to the extent that they have the financial ability, they get to a level that works for them. And sometimes they're very secure about their earnings, and they're like, I don't need to have this money saved for a rainy day. Other times they're stressed and they're bringing it down. The numbers in this survey on using debt to pay for Christmas gifts was not that high.
Good.
So it didn't speak to me of a lot of financial stress out there.
I love you. I knew you could answer anything I threw your way. Thank you, Steve.
Pleasure, Becky. Feelings mutual.
Okay. Coming up right after the break, investing in the most transparent companies. Cathie Wood introducing a new ETF that does just that. We're going to speak to her right after the break about that and some of her biggest holdings. Before we head to that break, though, let's get a check on the markets right now. We are in the red across the board. The Dow off about 81 points, NASDAQ off about 63 points, SP500 off about 14 points. We're coming back right after this.
Okay, guys, so I'm watching the 161. If we didn't hold this level here, we're going to 261, then 423. So we are up 784 right now. So just watch this level closely. If we start going back, I'll maybe close the trade and take a profit, wait for another rally, and I will reshort again. If this level didn't hold, maybe definitely we're going to 261. Okay, and if this doesn't hold, will be a good trade, and we're going to 423. So just keep your eye on this level. It feels like if he break 261, if we maybe go rally a little bit, then we hit the target 262. Like since if we broke to 161 here with this candle, we maybe rally a little bit, then we go to 262. Maybe we rally again a little bit, then we test 423. So Aussie dollar, you can see, I mean, the dollar is strong here and the Aussie is weak. So we are on right trade. Even if we rally a little bit, it's still red and green. Okay. So we are in a good trade for so far. I'm trying to make as much I can in next 10 days because a lot of banks, they taking a holiday for mid of December until 4 January. A lot of traders, they take off, and the liquidity, you can see crazy move. So I don't like to trade around the last week in December. So just want to let you know.
Our next guest, almost synonymous with some of the greatest growth and story stocks that we've seen in recent years. She was there early, been a long time a guest on the show. And we knew you when, Cathie Wood, CEO and CIO of ARK Investments. It's great to have you here this morning.
Good to be here again, Joe. Thank you. Thank you for inviting me.
You are very welcome. I want to start, and we'll talk about your transparency ETF in just a minute, but you're so associated with some of the greatest names in technology and some of the biggest, I guess, percentage gainers over the past 3, 4, 5 years. It's almost synonymous with ARK Invest and Cathie Wood at this point. I guess my question at this point would be, with interest rates perhaps finally moving in the opposite direction, does the whole thesis of seeing growth potential that goes out a number of years, as interest rates move up, does it threaten that thesis? And do you expect less robust returns? Is that to be expected in a lot of your funds?
Well, I think the market believes that because our performance this year has been challenged by exactly that, fears of inflation and interest rates picking up. It's been very interesting to us that once Chairman Powell made the statement that perhaps inflation is not transitory, that long-term interest rates actually came down. The bond market is telling us something here, and the yield curve flattened. The bond market is telling us either that we're going into a recession next year because inventories are piling up or will pile up, or that inflation is going to surprise on the low side of expectations. And we would bet more on the latter, although we do believe there's an inventory issue brewing out there.
Well, Kathy, would you tell your investors that, I mean, would you emphasize maybe that past performance isn't necessarily guaranteed in the future, the type of outsized returns that some of your major holdings have delivered in the past? Is that fair to say?
Well, we always say that, but I will tell you, since February through today, we have seen such a correction primarily in innovation stocks as the market has scaled to all-time highs, that based on our estimates, and of course we could be wrong, our 5-year compound annual rate of return expectation has gone from 15% at the peak in March to nearly 40% today. So from doubling over 5 years to a quadrupling over 5 years. Now, we could be wrong, but I think our research on innovation is the best in the business. And I also believe that most investors, and I know the most seasoned investors out there, some of them are saying that our stocks have been in bubble-like territory. We couldn't disagree more, because we are seeing 5 major innovation platforms involving 14 technologies, all moving into exponential growth trajectories simultaneously. And they're converging. If we're right that autonomous taxi networks are going to evolve during the next 5 to 10 years, then that involves the convergence of 3 major platforms: robotics, energy storage, and artificial intelligence. And all of them are scaling dramatically. What I like about this period is many, many people are saying those stocks were in a bubble and they deserve to correct. That tells me we are nowhere near a bubble. In fact, quite the opposite has happened. All of the seeds for what is going on right now were planted in the 20 years that ended in the bubble. They've germinated for the last 20, 30, almost 40 years. And now they're about to flourish and people are running away. They ran toward them way too soon during the tech and telecom bubble. And here we are, ready for prime time. And we've got all this fear, uncertainty, and doubt. As a portfolio manager, I actually love that backdrop.
I find the discussion fascinating, and I've been approaching it from 2 sides, Kathy, and that is, okay, rates probably are headed up. Some of these innovations are going to take years to come to fruition, so you won't see near-term earnings, EBITDA. You won't see any of that, maybe. But to get in on these things at this point, if innovation is going to continue to the time that it takes to shrink, and I actually, I'm a Kurzweil fan and singularity and everything else. I mean, the time dilation for quantum leaps in technology is getting smaller by the year. So you may have to pay up because it's going to happen much faster than people think. And we've seen that in a lot of the stocks that you've been in already. So maybe, I hate to say it might be different this time because it never is, but I don't know whether you need to worry about multiple contraction when you're really at the forefront of some of these just earth-shattering innovations. Does that make sense?
Yeah, and it makes sense. And there's one other assumption we make when we're talking about valuations. We assume massive multiple compression down to FANG-like multiples in 5 years in our 5-year projection. So we're already assuming multiple contraction just to be conservative. Now, do we think that the stocks in our portfolio and the companies underlying them are going to be as mature as the FANGs in 5 years? No, we're just being conservative, very conservative. Most, I guess, because of where we are today and the PE ratios, many people think we're in nosebleed territory. What they don't understand is we assume massive multiple compression. And I won't say we assume it either, because interest rates are going up. In fact, the convergence between and among the 5 major technologies, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, that convergence is going to be so massively deflationary that we actually think interest rates will remain surprisingly low.
But I'm back to now. Just flipping to the other side. It doesn't seem like it's always going to work to pick the most beloved growth stocks, put them in an ETF, and assume that you're going to have great returns and become iconic, which you have done, Kathy. Let me ask you about crypto, which there's a piece out. I think maybe CNBC even talked to money managers, and that is ripe. In 75% of those polled, that's ripe for a major correction or a major letting out of a lot of air in that sector. Does that sound like consensus, something to go the other way on to you, or not?
Well, yes, I believe it is. I think institutions are moving in. And right now, crypto of any sort, they're starting with Bitcoin and Ether. Crypto of any sort is a de minimis amount or percentage of institutional portfolios. The reason institutions are moving in is, to some extent, this is a new asset class with correlations very different compared to other asset classes. In fact, Yassin Almondra did a study on this and found that the closest, and we did it with Bitcoin, the closest correlation to other assets was real estate. And so institutional managers have to look at new asset classes that are evolving that have low correlations. That's the key to diversification, and it's the holy grail in terms of asset allocation. So we think that the move actually by institutions into Bitcoin, if we were to choose Bitcoin, and that seems to be their first stop, could add $500,000 to Bitcoin's price if they moved into the tune of roughly 5% over time.
Kathy, you could talk about, I guess we'd be remiss if we didn't talk about Tesla or Twitter or some of your other holdings. Can you opine quickly on what do you think about Tesla and where it is right now? Elon Musk's recent comments about the build back better, build back better, build, a lot of B's. But can you comment on that and Twitter? I know you recently...
I tend to agree with Elon Musk. I think more people understand now that the electric age is here. And so Tesla is being rewarded accordingly. It has the highest market share out there, and it has even now 4 barriers to entry that other companies are having difficulty overcoming, especially when it comes to battery technology and artificial intelligence, which will lead to autonomous. And that's now where Tesla is undervalued. You have to assume that the autonomous strategy is going to work. We assume in our $3,000 forecast that there's a 50% chance that its autonomous strategy is going to play out. And our confidence is beginning to increase now that the pilot test is taking place, and you've got devoted Tesla owners really identifying the corner cases that are causing problems for full self-driving. So we're pretty excited about that. Even its electric strategy should take the stock much higher than it is right now, but we are gratified to see that others are beginning to understand this story, and that Tesla is acting a little more FANG-like than it ever has.
How about Twitter? That you got to buy that and just, I guess, not watch it every day. Probably there's a lot of headwind. Yeah.
Well, we love, so the new CEO, we think, had been working with Jack closely on some of the new monetization strategies. We think tipping will be one of those. But there is a sleeper in Twitter that we think most people don't understand. We've moved into an age of NFTs, non-fungible tokens, and they will need a verification platform. NFTs are all about scarcity. And verification is testimony to scarcity. So we think Twitter might play a bigger role in that realm. And then, well, the main reason we own it, this we use it prolifically, as you do as well, Joe. And what we're seeing is that this platform, which used to be dominated by tweens, teens, and celebrities in 2012, when we first evolved our research ecosystem, has now evolved to knowledge workers. And we find it essential at ARC to engage with the communities we are researching and actually to become a part of those communities. This is a very powerful social network. And if you're talking about knowledge workers, you're talking about one of the premier demographic profiles out there. So we think from an advertising point of view, you've seen advertising turnaround on Twitter. We think that's going to continue. And we think more and more users will understand how essential this tool is to knowledge workers.
We all want to be transparent, I guess. I don't know. Sometimes I don't feel like being that transparent. But is there definitely a correlation between transparency and stock performance? And I guess that's the rationale behind this new ETF. Explain that to us.
Yes. So Paul Pagnato, who's CEO of Transparency Invest, after the 08-09 crisis, began to study this phenomenon. And of course, 08-09 was all about the lack of transparency. And so he devised an index, and you can find the index on our website, arc-invest.com, which evaluates which are the 100 most transparent companies in the world. So the ETF is CTRU, C-True, has a nice ring there. And, transparency for ARC, has been golden. We're able to have dialogues with our clients and prospective clients and anyone about innovation. And we have had more coming back to us in terms of information at times than we have put out there. Because as you know, we give away our research. We are radically transparent in terms of giving away our research, disclosing our holdings at the end of every day, as all ETFs have to do, but also disclosing our trades at the end of every day. And it has accrued to our benefit. In many ways, ARC Invest has gone viral as a brand because we're willing to share and engage with our clients, prospective clients, but really anyone in terms of educating them about innovation. The return from transparency has been huge for us.
Well, want to have you back soon. Thank you so much. And in the interest of transparency, I have to go to the bathroom so bad. I got to go. So thank you. In the interest of transparency, but I'm out of here. Thanks, Becky.
You said you were opposed to transparency. I almost fell off of my chair. I know your every waking thought and action. You are transparent, Joe, and he's already gone. He's already gone. Yeah, we know where he is. Still to come on Squawk Box this morning, we're going to break down yesterday's testimony from Instagram CEO Adam Mosseri and talk about the company's user policy when it comes to kids. Also, check out shares of Rent the Runway. They're under some pretty severe pressure this morning after results disappointed the street, actually down by about 10% right now. We'll be speaking to the Rent the Runway CEO, Jennifer Hyman, in just a bit. Squawk Box will be right back.
Time now for today's Aflac trivia question. Can you name the 5 most popular drinks in the world? The answer when CNBC Squawk Box continues.
Like I said early, if we break 161, it's a big chance we're going to 261, okay? And so far, we are trading under 161 extension. So you can take the 800 if you want, 805 and 996. If you want to hold, it's up to you. So it depends on your account, but I will hold a little bit. And if you guys have any question, please let me know in the chat room. All right, that's it for today, and good day, everyone. Take care.